I decided to do more of an educational video talking about some common mistakes, especially 5 mistakes that stock market investors make. And I actually know that people tend to make these mistakes from the feedback I get under my comments on some of my analysis video. I get asked pretty much the same questions. I get the same feedback pretty much every time. And I believe this is some pretty common mistakes that stock market investors make. And I believe you guys are really going to enjoy this video. It's very different from what other people make those mistake videos on YouTube, but it's not gonna get a lot of views. So if you enjoy it, all I ask, if you could please press the like button and maybe consider subscribing if you're a new viewer. Now the first one, and this is one of the most common ones, is they use price to book instead of price to tangible book. For example, they write me in the comments, look at this company, it's very cheap, it's trading below book value. Or look at that company, it's trading at 7-8 time book, 0.78 time book, it's trading below 1. That means it's below liquidation value, and that means the company is undervalued. And this is a very big mistake. Now, price to book, and I'm gonna use an example, and this is GEO, a company that I did many videos on, but it's a good example. Price to book is mainly the shareholders' equity divided by the total shares outstanding. This is how you get the book value per share. But the main problem with the book value per share, now, for example, in this case, it's around 1.1 billion. This is, the book value of the company, the shareholders' equity. Now, the problem is that shareholders' equity, or the price to book value, actually includes goodwill and intangibles. And a lot of companies, they try to inflate the goodwill to try to have positive shareholders' equity. But in real world, if they want to liquidate the business, they would not get the kind of goodwill and intangible assets they have on the balance sheet. Not all companies do this, but a lot of them do it. And this is an example with GEO. They have their goodwill at 755 million. Now, that's impossible. There's no way in the world GEO's goodwill is 755 million. I mean, there's CoreCivic, which is their competitor, is around, I believe, 20 million, or is like 5 or 6 million even. It's not nowhere close. And there's no way GEO's goodwill is 755 million. They have intangible assets, which is those electronic monitors, some other things they have on the intangibles, other systems, and it's around 151 million. So together, this is around $900 million. If you take them out of the shareholders' equity, you're left with around $210 million. So if you looked at GEO and you said, oh, the stock is cheap because it's trading at 0.85 times, book value per share. But if you look at the tangible book, it's trading more than 3.5 times, 3.75. So it's not as cheap as you believe. If you're just looking at, the book value per share, you must look at the price to tangible book value per share. And in order to get the tangible book value per share, you have to take out the intangibles, which is mainly the goodwill and any other intangible assets. Now, I'm using GEO as an example, but GEO in real life is actually trading below liquidation, because I talked many times about their assets being worth much more than they have it on the balance sheet. But this is the example I was trying to show you between price to book to price to tangible book. Now, if the company does have a franchise, some kind of a franchise business, or it has something like Google, their name is worth billions and billions of dollars, this is something you have to pay attention to the goodwill. But with most companies you're buying, when you're looking at price to tangible book or price to book, it's normally some type of a dying company, maybe a retail company like Kohl's with a lot of assets or something like that. You have to use price to tangible book and not price to book. This is the first mistake that people make. The second mistake that investors make in the stock market is they use return on invested capital without taking, the WACC within their estimate. WACC is the weighted average cost of capital. So if you look at a business, for example, like IBM has return on invested capital of 10%. Now, that's amazing, but a good return on invested capital is not enough. You have to look at what is costing them to get this capital that they are investing. And it's costing IBM around 5.31%. So 5% weighted average cost of capital, and the return on invested capital is around 10%. This is net pretty close to 5% of a net return on invested capital. This is something you have to look at, because many companies, for example, they have a 10% return on invested capital, but that weighted average, cost of capital is more around 12 to 13%. In this case, they have a negative, return on invested capital, which is something that you really don't want. And that means that the company is not creating value for long-term shareholders. It's actually destroying value every single year. So you must pay attention to the weighted average cost of capital and, take it together with the return on invested capital for you to make a very good judgment about any, stock or business you're actually buying. Another common mistake is they pass on companies because of low metrics. For example, you look at some company like CVS or Walgreens or whatever, like let's say, for example, Walgreens, and you look at the return on invested capital, you say, oh, that's is low, it's like 3 or 4%. You go and you look at the, return on equity, it's very low. You go and you look at the return on assets, it's very low. And all these fancy metrics, you look at all of them, you don't find them, for example, attractive. The return on invested capital is not 20% or 15%. So you say, no, I'm out. I don't want to touch this business because all those metrics are very, very low. And this is a big mistake that people make. And this is something very common. I get in the comments and people in my own group, they immediately tell me, oh, but the return on invested capital is low or the return on equity is low. And I tell them, okay, but how much are you paying for those metrics? For example, if the return on invested capital was, 3% and you're paying 25 times earnings, this is very, very expensive. But let's assume the return on invested capital is 3% and you're paying 6 times earnings. Now, that's not too bad, right? I mean, this is what you have to look at. You have to look at those metrics. They are very important, but you have to look at how much are you paying in relative of those metrics. If you're paying a very expensive price for low metrics of those, whatever you look for, return on invested capital, return on equity and stuff, then this is something very, very bad and you must avoid it. But before you pass on any stock because the metrics are low, you have to look at, how much are you paying for those metrics? And if the price is right, then the stock is a buy. If the price is not right, it's expensive, then, it's not a buy. And this is how I look at it. Another very common mistake stock market investors make, and this is the one that bothers me the most, and I just can't believe how many people actually do this, and they pass on a business because of high debt. Everyone wants the perfect balance sheet. They want the highest cash position, the lowest amount of debt, and they only buy stocks that have, a low debt or no debt in general. They want in a perfect balance sheet. And I get it. If this is the type of investor you are, to me, it's fine. But if you're more open-minded like myself and you're willing to buy anything for the right price, you don't avoid a business just because the debt is very, very high. The question I ask myself, is the debt manageable? Is the business model cyclical or not cyclical? This is very, very important. As I said many times, if you're buying, something like Carnival Cruise Line, which is very, very cyclical, and they have a crazy amount of debt, you should be very, very worried. Maybe you could pass on it if the debt is very, very high. But let's say you're buying something like Costco, and it has a very high amount of debt. In this case, I would not be worried if the price is right within Costco. Why? Because Costco's business is not cyclical. They have high free cash flow. They can likely manage the debt. But this is where you find a lot of opportunities in the market, because most investors, when they see high debt, immediately they skip the company. And that creates a lot of opportunities if you're willing to dig in deeper. Okay, why is the debt high? What is the maturity on this debt? What is the interest rate on this debt? Is it fixed or not fixed? Is it manageable? Do they have any assets they can sell? This is the questions I ask myself, and I always get a lot of pushback from many people on YouTube, and I got it many times within new members in my own investment group when I was buying a stock like I talked about before, CSV, which is a funeral home company. Now this company has a lot of debt. They take the debt and they do a lot of things with it. Now most people, they skipped this company. Why? Because they have very high debt. But the question I ask myself, is the business model sustainable? And of course it's sustainable. I mean, they're going to make free cash flow in anything that happens. If the dollar goes up or down, if interest rates go up to 20%, unfortunately people pass away, and they're going to make that free cash flow. So the debt is manageable, and they are doing something good, with this debt, with reinvesting it, which is something I really want to do. So this is how I look about a company with high debt. I don't skip it immediately if it says, net debt is crazy. I go and I look, why is it crazy? What is the terms? What is the interest rate? Is it manageable? And and is the business cyclical or not? This is the things I look for. Now, this is the final one, and this is maybe the most controversial one, and this is the one that's most likely gonna get me, a lot of dislikes, but I have to talk about it because I see a lot of people doing this, is they use a DCF for everything. If they value a growth company, they use a DCF. Oh, Snowflake is overvalued. They go and they look for a value stock like, something like IBM, let's example. And they use the DCF on IBM. They say, oh, IBM, for example, let's say is undervalued. They value ExxonMobil with a DCF. They value a gold miner with a DCF. They value a royalty company with a DCF. They value everything with a DCF. Now, this is a big mistake because there's many different ways to value a stock, and each industry has to have a certain way. Sometimes you have to lose liquidation value with many companies, for example, like GO and CoreCivic. Sometimes you have to use, PE ratios with some tech companies. You have to, estimate something a little bit in the future. You can't really use a DCF in everything. And me personally, I don't use a DCF at all. And the reason for that is because everyone else uses a DCF. You can go on any websites, they can make you a DCF, on the computer can make a DCF. The algos are programmed on DCF, and everyone is using a DCF. So if a DCF is saying this business is overvalued, and maybe if I use some other metrics and other valuation methods, I find that it's undervalued. This way I exploit a lot of opportunities in the market, and I don't want to do what everyone else is trying to do. And this is something, that Seth Klarman said. He said, while investors need to focus great attention on the fundamentals, they have to ask the question, what's your edge? You cannot have an edge doing what everyone else is doing. To add value, you must stand apart from the crowd. And this is why I don't use a DCF. I use my own metrics. I use, some PE ratios. I use some other type of things. I look at the, average PE ratio. I have a lot of other, things I do look like, and I showed you many of them within some royalty companies like Sandstorm here on YouTube, how I valued it on the present value and many, other things. But I don't go and use a DCF for everything, and I don't use a DCF at all because everyone else is using it. The computer can make you a DCF, so I have no edge, in anything I'm pretty much doing if I'm using the same exact things that everyone else is using. And it's the same thing with high debt companies. People say, oh, it's high debt, they skip it. But no, this is what I want. I want you to skip it because that creates an opportunity for me, and then the market realizes the opportunity, and this is how I can make, pretty good returns in a short period of time. Now, those were 5 mistakes that stock market investors make. I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.